Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through a Noise podcast. This week started on a frenzy as investors scrambled to assess the impact of the assassination attempt on former US President Trump over the weekend, which betting markets saw as a boost to its odds at the upcoming US presidential election. Correspondingly, the quote-unquote Trump trade saw a revival in the financial markets. To discuss these and more, I'm glad to have Fook Hien, our senior investment strategist, back on the podcast. Welcome, Fook Hien. On the Trump trade, what are you seeing in the different parts of the markets, and how does it gel with other macro data and events this week?
Thanks, Dong. Yeah, as you said, the markets are pricing in a high chance of a Trump victory. For investors, we believe this means balancing the impact of proposed Trump policies of higher tariffs and spending, which are arguably pro-growth but also inflationary. You balance this with the major market drivers that include disappointing economic data, likely Fed rate cuts, and a near-term pullback risk. We see these divergences creating opportunities, and we will take advantage of short-term sectoral rotation within US equities and improving Japan market technicals. In bonds, while it has been argued that Trump's policies should result in higher US bond yields, we have soft economic data, and the Fed rate cut expectations have so far continued to push yields lower. We believe the Fed will ultimately drive bond yields lower. Recent data and policymaker comments support our view that the Fed will start cutting rates in the second half of this year, likely in September. And this means that investors, they face a narrowing window to lock in today's attractive yields before the short and long-term yields move significantly lower. Another big move in the market has been the Japanese yen, where the US dollar to the Japanese yen fell around 3% over the past week in a suspected policy intervention move. While history suggests that intervention alone is unlikely to create a lasting currency move, for now we see a negative bias for the US dollar to the yen with resistance at 157.6. The currency move has improved the near-term technical outlook for Japan equities, creating a regional rotational opportunity at a time when the US market is facing a stretched positioning. Our own proprietary indicator on US equities is pointing to a 2/3 chance of a short-term pullback.
Diving a little deeper into the Trump trade, assuming Trump does win the election in November, which equity sector would benefit the most?
Yeah, since the assassination attempt, the key US market outperformers have been the small caps, financials, and the energy sector. Now, these sectors benefited because of raised expectations of, firstly, loosening financial sector regulations, secondly, America First policies, improving conditions for the smaller US companies, and thirdly, a better environment for the traditional energy companies. So unlike the crowded positioning on growth sectors like technology, investors currently have a light exposure in these three areas. Financials have seen favorable earnings as well, and the energy sector stocks, they could move higher in a Trump win scenario given his proposed supportive policies. The higher borrowing costs over the past 2 years, they have been a headwind for the small caps in the US. However, this could be alleviated to some degree as the Fed is signaling a greater willingness to cut rates in the second half of the year.
Well, the other key event this week is the ECB meeting, and that came after the conclusion of French elections. So how do these developments impact your view on the Euro area government bonds?
Yeah, the French election resulted in a hung parliament with no party holding an absolute majority. Being the first hung parliament since 1958, the political situation is likely to remain fluid for now. However, President Macron is likely to remain in office until the end of his term, which should keep fiscal policy stable. Major rating agencies, they've also retained their stable outlook on France, and we believe a rating downgrade is unlikely in the short term, as the next review window is likely a few quarters away, and agencies, they usually wait the first post-election budget to evaluate a fiscal risk. With the French election risk behind us, the focus will likely shift to ECB policy action. The July policy meeting was concluded without rate cuts, and the policymakers, they remain data dependent while leaving a rate cut window open in September. Markets are expecting a 25 basis points cut in September. So on the back of the completion of the French elections and a still favorable monetary policy backdrop, we retain our tactical buy on the Euro government bonds with the FX hedged. We expect this to be supported by a narrowing real premium between French and German government bonds as the French political environment stabilizes.
Before we end, let's touch on gold. The yellow metal posted a new record high this week. So what's next for gold?
Yeah, the gold price has been strong indeed, and we attribute the price gains to three factors. One, the higher Fed rate cut expectations on the back of lower inflation, softer growth data, and the dovish Fed speak. And two, lower real yields in the US and a weaker US dollar. And three, the rising odds of a Trump victory coupled with increasing geopolitical uncertainty. Interestingly, history shows that gold prices, they tended to decline under Republican administrations. Now, a possible explanation for the different price reaction this time is that Trump's proposed policies are likely to worsen the fiscal balance and are likely inflationary in nature, enhancing the appeal of gold as a safe haven and an inflation hedge. That said, we think the gold rally is looking increasingly stretched. The copper to gold ratio has fallen to its lowest since late 2020 and running ahead of the decline in the US 10-year government bond yield. Meanwhile, the Relative Strength Index, or RSI, it also points to overbought conditions for gold. Therefore, we believe the bar for a further extension of the rally is high, and the next technical resistance lies at a key psychological level of $2,500 per ounce. On the downside, the precious metal is supported by the 50-day moving average at around 2358.
As usual, the key points I drew from this discussion are proposed Trump policies of higher tariff and spendings are arguably pro-growth but also inflationary, and that has to be balanced with market drivers that include slightly Fed rate cuts and near-term pullback risks. The favorably monetary policy backdrop in euro areas presents an opportunity for euro government bonds on a hedged basis. And lastly, the bar for a further extension of the gold rally is high. Thank you so much, Fook Hien, and thank you all for listening from start to end. Enjoy the weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.